Many people are starting their New Year's resolutions, budgeting, saving, or finally checking their credit. It's also a good time to look at what's changing in housing. Updated mortgage rules are on the way, and for first time homebuyers, those changes could matter more than most people realize. The U.S. housing market is facing a growing problem, and it's not just high home prices. Today, many first time homebuyers are locked out of the market.
Home buyers are getting locked out because of high interest rates, keeping people from selling, and a spike in all cash offers. On top of that, millennials, the nation's largest generation, they're competing against empty nesters who have more savings for the same properties. While mortgage rates are coming down from their recent highs, and there's a lot of eyes on what the Fed will do this week.
Even when they have steady income, stable employment, and the ability to make monthly payments. Rising interest rates, elevated home prices, and strict credit standards have created a widening gap between who can realistically afford a home and who can actually qualify for one. In many cases, credit score requirements have become the main barrier. Buyers with solid income and strong rental history are being denied mortgage approval because of credit scores impacted by medical debt, student loans, or short-term financial setbacks that tend to follow people longer than expected. At the same time, housing supply has remained limited. New construction has not kept pace with demand. Inventory remains tight. Higher interest rates have also discouraged existing homeowners from selling, keeping fewer homes on the market. The result is a housing market where affordability is strained and access to homeownership is increasingly uneven. Housing in the United States has never been left entirely to the free market. Homeownership is closely tied to economic stability, family formation, and long-term wealth. When housing access becomes either too restrictive or too risky, the broader economy tends to feel the effects. That is why, throughout history, the federal government has stepped in when housing markets fall out of balance. To understand today's discussion around credit scores, it helps to look at how housing policy has evolved over time. Before the Great Depression, mortgages were very different from what we know today. Loans were often short-term, required large down payments, and ended with balloon payments. When the Great Depression hit, millions of homeowners defaulted at the same time, and the housing market collapsed. In response, the federal government introduced tools that still shape housing today, including the 30-year fixed-rate mortgage, Federal Housing Administration insurance, and federal backing designed to reduce lender risk. The goal at the time was stability, not rapid expansion. After World War II, the challenge shifted. Millions of returning veterans needed housing, and the government responded with VA loan programs, offering low or even zero down payments and favorable loan terms. Homeownership was promoted as a pathway to middle-class stability and economic growth. This expansion worked, but access was not evenly distributed. By the late 1990s and early 2000s, housing policy shifted again. The focus became increasing home ownership rates as aggressively as possible. This era introduced subprime mortgages, adjustable rate loans, and loan products that required little to no income verification. Risk controls weakened, and mortgage-backed securities spread that risk throughout the financial system. At first, access expanded rapidly, but it was not sustainable. When housing prices stalled and interest rates adjusted, defaults surged. This led to the 2008 financial crisis marked by mass foreclosures, bank failures, and a global recession. In response, lending standards tightened sharply. New rules required full income verification, ability to repay standards, higher credit thresholds, and stronger oversight. These changes stabilized the financial system, but they also raised barriers for many first-time homebuyers. Fast forward to today. The housing market now faces three pressures at once: high home prices, elevated interest rates, and limited housing supply. Many financially responsible renters can afford monthly payments, yet still struggle to qualify for a mortgage. This is the environment driving policymakers and lenders to reassess how credit scores are used, not to remove safeguards, but to refine access. Starting in 2026,
For years, the minimum FICO score to get a loan has been 620.
They have removed that 620 requirement. So someone with a score lower than 620 can now potentially get approved.
Companies that provide capital to the mortgage market are expanding the scope of credit profiles to include utility and rental payment history.
The older FICO scores didn't. So they're trying to bring those in to give a better picture, profile picture of someone's credit. So they're trying to move in the right direction.
Mortgage credit score guidelines for first-time homebuyers are expected to change. These updates may allow some buyers with lower credit scores to qualify for mortgage approval compared to current standards. This does not mean credit checks are disappearing. Borrowers will still be required to verify income, employment, and debt obligations. Credit score remains one factor within a broader underwriting process. The goal is to expand access, not eliminate risk controls. Naturally, comparisons to the 2008 housing crisis have surfaced. However, there is a key distinction. Before 2008, many loans were approved without verifying income or ability to repay. Those practices are no longer permitted. Today's lending environment still requires full documentation and compliance with post-crisis safeguards. This is not a return to pre-2008 subprime lending. Similar approaches already exist in other countries. Canada, the United Kingdom, Australia, and New Zealand have expanded access to home ownership through adjusted credit requirements for first-time buyers. However, these systems rely heavily on affordability checks, debt limits, and stress testing. Regulators actively adjust rules as market risk rises or falls. The United States is not creating an entirely new model, but moving toward an approach already used internationally. Expanded access does come with potential risks. If more buyers qualify for mortgages without a corresponding increase in housing supply, demand could rise faster than inventory, placing upward pressure on home prices. Borrowers with lower credit scores may also face higher interest rates, increasing monthly payments and vulnerability during economic downturns. There is also the possibility of higher default rates if economic conditions weaken. These risks do not mean a housing crash is inevitable, but they highlight the importance of careful implementation and oversight. Between now and 2026, several factors will determine how these changes unfold. Lender behavior, interest rate trends, housing supply, early delinquency data, and regulatory adjustments will all play a role. Policy alone does not determine outcomes. Markets do. Ultimately, these changes represent a shift in access, not a guarantee of affordability. How they affect first-time homebuyers and the broader housing market will depend on execution, economic conditions, and supply. As 2026 approaches, the central question remains: can expanded access coexist with long-term stability? If you found this helpful, like the video and subscribe for more housing and market analysis. And let us know your thoughts in the comments. Thanks for watching.